Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I would look at the financial documents of a company and decide if I was looking for another investment, would I buy or pass? Before we start, don't forget to hit that subscribe button to get info on new episodes and other videos. Also, don't forget to check out my website, josenajarro.com, to get more free info and information on my podcast. So let's begin. So like always, I'm going to use this website known as lazyfa.com, which allows me to look at all these financial numbers in an easy visual form. Today, we're going to take a look at GIS. Alright guys, so today we're going to take a look at GIS, General Mills. Just for those that don't know, this company, they sell a lot of snacks, baking goods, ice cream, yogurts, and other consumer foods. Just so you guys understand the company we're looking at today. Okay guys, so here we're on the income statement of GIS. They reported their earnings, their most recent earning was mid-December, so about a month, 2 months ago. We still have some time for the next earnings, so it's definitely a good time to take a look at their revenue. We're going to look at the quarterly data opposed to the annual data, just because the annual data does not end until March. I believe. Is that March? March or April? So we still have time, so might as well just look at the quarterly data for now. So here, quarterly data, we can see revenue has been pretty flat. It's been increasing little by little, but not that much. For example, this past quarter, we had a $4.41 billion revenue. Same time last year was $4.2 billion. So an increase of about $0.2 billion. Cost of revenue has also been increasing almost at a similar chart to revenue itself. We can see here they follow the same pattern. This year, cost of revenue this quarter was 2.9 billion. Same time last year was 2.75, an increase of almost 0.15 billion, where revenue increased 0.2 billion. So it seems like this revenue and cost of revenue growth is almost a 1-to-1 ratio, pretty close to it, and we can see the gross profit seems to be pretty flat throughout the past few quarters. Right now it's at 1.51 billion, and it does not, like we can see through these charts, it doesn't seem like it's growing. It seems to be at a peak average compared to other quarters. Next, we're going to take a look at net income and earnings per basic share, which are pretty much the same information we see, just in different ratios. So the only thing, net income here, we had one outlier in 2018 when they reported for their February 25th. So here we can see we have this outlier. It's one I really won't take a look at, but if we look at the overall trend outside of those, we can see that here we have a downtrend happening in net income. So as a result, we have that downtrend happening in earnings per basic share. Next, we're going to take a look at red flags, which is something Lazy FA does. At first, we're just going to see the same charts we just saw and just differently grouped together. Here we can see revenue versus cost of revenue. We can see it's been pretty flat the past 2 years. Let's take a look actually at the quarterly data. Same thing here, right? Pretty flat throughout the past few years, and we can see that gross profit, it seems to be pretty flat as well. So to me, this company has not been growing over time. Let's take a look at gross and profit margins. So here, gross margin, again, pretty average compared to itself, and profit margins, actually profit margins to me seems to be having this downtrend happening here. Right now it's actually at 7.8, where last quarter was 9.6, the previous quarter was 9.1, and we can see most of the quarters have a gross profit margin, of over 9%, where this quarter was a 7.8%. That's honestly something I do not want to see, especially for something so low in profit margins, to have margins decrease over time. So here, Lazy FA gives us 2 red flags. The first one is just telling us that revenue growth is growing at a slower pace compared to cost of growth. So cost of growth is growing faster than revenue, and that's something we did mention and we saw, and that's why we have that pretty flat line gross profit, maybe a little downtrend happening. The next red flag is giving us is top to the bottom line alert. This is actually a pretty good flag that I was just reading through. And this alert is telling us that on average, revenue growth and net income growth should be growing at a similar pace. But here, that's not happening. Here, we have net income growing even though revenue is not growing. So that's pretty fishy, and it's just telling us, hey guys, this is pretty fishy. I don't understand why revenue is not growing, but at the same time net income is growing. So that's just one of the flags. Those are the two flags Lazy FA is giving us right now. Next, we'll take a look at the balance sheet. Here in the balance sheet, like always, right, we'll take a look at the quarterly data, and I can see already I don't like what I'm looking at. So even though total assets have increased from almost a year ago, 3 quarters ago, it was 22.24 billion. Now it's about 30.3 billion, an increase of 8 billion in assets, but we can see liabilities also increasing at that same time, where liabilities was 16.09 billion and now it's sitting at 22.86 billion. So an increase of over $6 billion, where assets increased by $8 billion. That I don't like to see. That's like, again, it's almost growing at that 1:1 ratio, which is pretty scary. And here we can see why the total liabilities is increasing. We have this total debt jump the past 3 quarters. It has seemed to be paying it off surely but slowly, and a little too slowly for me. In 3 quarters ago, February 25th of 18, total debt was $9.62 billion. Now it's at $15.26 billion, over an increase of about 60%. Payables and receivables are here, and I don't like to see that. Payables money coming out is definitely higher than the amount of money coming in, and we can see over time here payables has just been increasing and increasing and increasing, where right now they're paying about $2.8 billion per quarter, where they're only receiving about $1.72 billion per quarter. Cash and cash equivalents, again, we see that downtrend happening. It is uptrending from the past 3 quarters, but it's still a downtrend from its average of where it is supposed to be. So on average, it seems it's somewhere around 800 to 700 million dollars. Right now, it's sitting at 532 million dollars. So it is increasing its cash and cash equivalents, but this past few quarters, how it dropped over 50% is a scary thing. Next, let's take a look at the balance sheet again. We have some red flags here. We'll take a look at total assets and total liabilities. Here we can see in the quarterly how assets and revenue and liabilities are increasing both at the same time. Shareholder equity has been pretty flat. It dipped down and it has increased over time. So that's good to see that it has been increasing, but it's still pretty flat to where it was in 2012. Next, we'll take a look at the asset distribution and liability distribution. I don't really like right now. We're taking a look at the asset distribution. Sorry, let's take a look at the quarterly. I don't like how intangibles are worth this much growth, and how intangibles grew from $13.4 billion to $21 billion. To me, this is looking pretty scary that assets grew that much on intangibles. That's actually almost 75% of the asset distribution. I would not like to see an asset distribution where 75% of my assets are intangibles. Why couldn't it be cash or cash equivalents or current investments or something else? But that, to me, is ridiculous, and I'm not liking it at all. Here we can see this non-current debt, current debt being 61% of this company. 61% of the company is non-current debt, and 15% is current debt of $3.15 billion. So the just debt alone makes up about 77% of this company's liability distribution, and 73% makes up intangibles. That to me is ridiculous, and it's definitely I've already made my decision. This to me is definitely a pass. I would not touch GIS anytime soon. Here we have some red flags. right here is telling us, this red flag is telling us exactly what I was just mentioning. Intangibles should not be total assets. They should not be worth 71% of total assets. Again, and here it's telling us growth outweighs liability growth is outweighing asset growth, so it's saying liabilities is growing at a faster rate than assets. So yes, this is one of the scariest things I've seen. Then let's see what other flags is giving us. It's giving us a debt growth, that load is increasing dramatically. Next, I mean, we already have the answer to this question, but let's just keep looking. Maybe they might have something we don't know, right? So cash flow statement. Here we have cash flow statement. Net cash flow statement is on the positive side, but it's pretty low money at $789 billion. We can see it's been pretty average compared to the previous quarters. It's not really gaining or losing. So take that to that. Next, we'll take a look at metrics. Metrics price to earning ratio has decreased. That's, I guess, a good thing, but I'm pretty sure it's just company people do not want to buy this company just because how bad it looks. Look at its debt to equity ratio has increased over time. So if you guys, let's just take a quick look at overview, right? Let's take a quick overview. Revenue, right? Revenue pretty flat, cost of revenue pretty flat, gross profit pretty flat over the map. Net income seems to be decreasing, have a downtrend, and so the same thing, we see that earnings per basic share. If we take a look at red flags, we see here that profit margins have decreased quarter to quarter. Last quarter was one of the worst quarters in some time at about 7% profit margins compared to its normal 9% profit margins. Next, we take a look at balance sheet. Balance sheet, oh look, assets have increased dramatically over time, but that assets is 75% intangibles. So to me, nonsense. Liabilities have increased 75%. About 75% of liabilities is current and non-current debt. Non-current debt is about 63%, where current debt is about 15% or so, like I mentioned earlier. Cash and cash equivalents have been dropping. This company barely has any cash compared to what it normally used to have. It would have somewhere around 600 to 800 billion. Right now, it has 532 billions. It's not collecting much money from receivables and is throwing a lot of money away from payables compared to receivables. With cash flow statement, it does have a positive cash flow statement. Again, it looks pretty flat compared to compared to all the years. And finally, we'll take a look at metrics. Metrics price to earnings ratio is going down, so that means this stock is pretty cheap compared to 2015. But something this bad should definitely be cheap. Debt to equity ratio has increased, again dropping the need for this company. Profit margins year to year, this past year was 813%, but if we look at quarterly, that was due to one outlier in 2012 that gave that huge profit jump. That to me is definitely a scary thing, and we have not seen that ever again. So to me, GIS will be 100% pass. I am not touching this with a 10-foot pole. So I hope you guys enjoyed that episode as much as I did. GIS, like I mentioned, for me would be a pass. I wonder what's gonna be for you guys. Post on the comment. Let me know what you guys are gonna do with GIS. Again, don't forget to hit that subscribe button to get info on new information, new episodes, and don't forget to check out my website josenajarro.com to get more free content. Have a good day, guys, and see you next time.